Hi, I'm Tom Gilbertson, Investment Analyst at Loftus Peak. Welcome to Update Plus, our monthly update on the big disruptive trends that are driving business and our portfolios. January was a bruising month for enterprise software stocks. The AI disruption narrative reached a fever pitch following the announcement of new products from Anthropic and OpenAI, signaling a more concerted push into the enterprise market. Software names, especially those concentrated on the application side like ServiceNow, Salesforce, and Intuit, suffered drawdowns as much as 25%, wiping out hundreds of billions of dollars in value through the sector in the month. Investors are wondering what the software landscape looks like in an AI-first world, where companies can build agents, AI companies sell software, and users are reduced as agents do more work. What's driving these moves is a fundamental shift in how technology is built. Vibe coding tools like Lovable democratize software development, potentially undermining the moat held by SaaS incumbents. How can software companies compete with AI companies with agents? How do SaaS incumbents fare when increased AI usage erodes the seat-based billing model? However, as is often the case in volatile markets, this narrative misses the nuance. The market is currently selling the story, but is largely ignoring the fundamentals. Recent earnings from Microsoft and ServiceNow aren't a picture of businesses in decline. Microsoft's Azure business grew 38% year on year and would have grown more if management hadn't provisioned more capacity for first-party apps like Copilot and their own internal AI research and development efforts. ServiceNow delivered beats on revenue, earnings, and guided to a strong fiscal year against a soft macro backdrop. The results were objectively good, but not good enough, with the stock selling off 10% in next day's trading. One of the important nuances that is being ignored at the moment is that enterprises are buying a product, not just code. A SaaS product comes with security and guardrails required within a large enterprise to ensure critical systems operate as expected. The workflows that software companies facilitate are typically complex, with many geographies and teams involved in execution. You cannot simply generate one using vibe coding. These require domain expertise and specific private company data that generic models just don't have. At Loftus Peak, our belief is that disruption will roll through each and every industry, and our task is to look through the noise and identify this disruption and allocate capital to take advantage of it. One of the frameworks we use is the life cycle of disruption. It starts with the tools, moves to the enablers, which are the cloud providers, and then the final and longest part of the cycle are the beneficiaries. AI is only at the very beginning of this cycle, with most of the value thus far accreting to the semiconductor companies underpinning AI development. Our portfolio is heavily exposed to this area through our positions in NVIDIA, AMD, Broadcom, TSMC, and others. The beneficiaries of disruption are still yet to come, and it's likely that while some software companies will be beneficiaries, others will be disrupted if they do not pivot quickly enough to embrace AI. Our job is to find those companies that will benefit from disruption at carefully determined valuations. The wholesale rejection of software names over the past month has created a dislocation between price and value for some of our favorite software names. Datadog, for example, is providing the critical observability platform used by AI companies, including OpenAI, for real-time remediation in its digital infrastructure. Samsara is digitizing the physical operations of real-world industries, a complex task to try to vibe code. Microsoft maintains a robust cloud and SaaS businesses, plus owns a controlling stake in OpenAI itself. We are not dismissive of the long-term risks to software from the rise of AI. The democratization of app development and rise of AI-native companies, plus the shifts occurring in the labor market, are all considerations in our outlook. Some software companies will undoubtedly be disrupted, but we believe the software stocks we own are well positioned to navigate through and benefit from the coming disruption. In addition, we always anchor our portfolio decisions to valuation and carefully select companies for inclusion in the portfolio on that basis. I'm Tom Gilbertson. Thanks for watching.